Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Today, we review the performance of international equity markets in a year which has certainly provided several surprises to global investors. Some of these surprises would have included the outcome of U.S. presidential elections, the agreement by OPEC and non-OPEC producers to cut production of oil in the coming months, the decision in the UK to leave the European Union, known as Brexit, and most recently, the interest rate announcement of a U.S. interest rate increase and a faster than expected growth rate in the pace of interest rate increases. Against this backdrop, 2017 will provide several opportunities and possibly moments of volatility to global investors. So let's take a closer look at some of the performances of the regional markets year to date and what could be lying ahead in 2017. And let's turn first to the S&P as measured by the US index as measured by the S&P 500. And as we can see, the year got off to a rocky start with a collapse in crude oil prices, which would have led to an almost 10.5% decline in the major US market index. The gradual recovery in oil prices would have led to a commensurate recovery in the US equity markets, with Brexit having a minimal impact on confidence in the US region. The next real major catalyst for equity markets in the US came with the outcome of US elections, where, to the surprise of many, Republican candidate Donald Trump emerged victorious. But it seems the market is liking what some of his policies are, and that would include increased investment in infrastructure spending, as well as cuts in or proposed cuts in corporate taxation. And post-election, the market has rallied around 4%. And that takes the year-to-date advance up almost 11%. Turning to Europe, Europe has been broadly lower, down 5% on average year-to-date. And most of the major markets have been in negative territory, with the exception of France and Germany. France is just treading water at about 0.3% year-to-date, while Germany is up around 2% year-to-date as well in US dollar terms. The major news in Europe, of course, was the Brexit referendum. And in the 4 days following the surprise outcome of the vote, which was to leave the EU, the market would have declined around 16% in Great British Pound terms. Now, year to date, the UK market, as measured by the FTSE 100, is up around 12% in sterling or Great British Pound denomination, but in US dollar terms, it's down around 5% or 5.3%, and that's attributable to weakness in the Great British Pound currency versus the US dollar. Looking at Latin America, definitely one of the surprise outperformers for 2016 thus far, given a dismal 2015 in which the markets in Latin America on average were down about 32%. And on average for 2016 so far, they're up around 27%. And this has been driven primarily by major advances in the Brazilian economy, despite weaker economic fundamentals, which is up around 60% year-to-date in US dollar terms. And about half of that has been attributable to improvements in the currency of Brazil, the Brazilian real. Peru is also up around 56% for the year, while Colombia and Chile respectively are 23 and 21% up in US dollar terms. Now, as we can see, Mexico has been the laggard in the Latin American region, down around 10% year to date, and much of this would have come post-election with the outcome of the US presidential elections again. And it's known that the incoming president is quite vocal, or has been quite vocal, about his stance regarding relations with Mexico, and this could lead or has been leading to a negative sentiment, investor sentiment in the region, with the markets down 13% post-election, and the currency also weakening about 10% since the election results. Finally, turning to Asia, Asia has been a mixed bag after a weak 2015. The region's largest economy, China, is down around 17.5% year-to-date, driven by lower growth expectations. And we use the term lower growth expectations loosely, as China is still growing well above the 6% per annum rate in GDP. Whereas Taiwan, a much smaller economy, was the best performer at around 15.5% year-to-date. The rest of the region, particularly India, even though it's growing in excess of 7% per annum, has been impacted predominantly by US interest rate decisions, whereby interest rate increases tend to increase the level of volatility in emerging markets, India and wider Asia being some of those regions. So, as we turn to 2017, the obvious question would be, how can you, as an international equity investor, better position your portfolios, whether they include US equity or international equity stocks and mutual funds, to take advantage of some of the market drivers in 2017. And some of these key drivers which prevailed in 2016 will also cross over into 2017, and these would include US international policy, in particular when President-elect Trump takes office in early 2017. What will be his impact on international relations, international trade, and other geopolitical factors, and the confidence that he instills in the international equity markets and US equity markets. In other market drivers, the US Federal Reserve and their interest rate decision and guidance on the rate path of interest rate increases will also affect international equity markets. And it should be noted that at the end of 2015, it was expected that there would be 3 to 4 interest rate hikes in the period 2016, where only one materialized. That's most recently in mid-December. And now 2 to 3 interest rate increases are also expected. So only time will tell what the real path of the interest rates are. And of course, commodity prices, often used as a barometer for growth in the global economy, which will again affect global growth, will influence international equity markets. So with the year coming to an end, there could be still 1 or 2 surprises thrown into the mix for global investors by international stock markets. However, we at Bourse would like to re-emphasize our investment themes for the long term, which include lengthening your investment horizon to be able to ride out the market and economic cycles which occur from time to time, targeting positive inflation-adjusted returns, which means ensuring that your wealth grows in real terms, diversifying by asset class, having a bit of investments in stocks, bonds, mutual funds, and other investment opportunities, diversifying by geography, that is not having all of your investments focused in one particular area or region, and diversifying by currency, which is important for Trinidad and Tobago investors to have not all of your funds or investments in Trinidad and Tobago dollars only, but having, as far as possible, some of your investments in a major currency such as the US dollar. That's it for this week's edition. To learn more about how Bourse can add to your value, give us a call at 628-9100, email us at invest@boursefinancial.com, or visit our website at www.bourseinvestment.com. That's it for this week's edition, and on behalf of the entire team at Bourse, I take this moment to wish you and yours a very Merry Christmas, and indeed a safe, successful, and prosperous 2017. Have yourselves a great investing week, and a merry little Christmas. This has been the Bourse Report.